If you're an LDS parent trying to figure out where to save money for your kid's mission over the next 10 years, you're probably being told to open a 529 plan, right? Here's the problem. That advice could cost you thousands of dollars in taxes and penalties. I'm talking real money here. Potentially 10% penalties plus your full tax rate on the growth. And I see families make this mistake all the time because, well, it sounds like it should work. But in this video, I'm going to show you exactly where you should actually park that mission money, why the 529 trap is so dangerous, and the hybrid strategy I use with my own kids that gives you flexibility whether they serve a mission or not. But you need to stick with me through the whole thing because if you miss the strategy at the end, you might set money aside in the wrong place and lose access to it when you need it most, 24 months before your missionary walks into the MTC. Real quick, I'm not a certified financial planner, so this is educational content only. But I am an LDS dad currently saving for 2 future missionaries, and I've spent the last year deep in the weeds of tax code, talking to other parents, and yes, making some expensive mistakes so you don't have to. Just last year, I met with a family who had faithfully saved $15,000 in a 529 plan for their son's mission. Great discipline, right? Except when their son got his call, they realized they couldn't use that money without penalties. They had to scramble, take out a personal loan, and now they're paying interest on money they already saved. That 529, it's just sitting there for college now, but they're in debt for the mission. Let's establish the battlefield here. For a young missionary from the United States, you're looking at about $400 per month. That goes to the church's Equalized Mission Fund. Over 24 months, that's $9,600. But that's not the full story. Before they even leave, you've got the outfitting costs, suits or dresses, luggage that can survive 2 years of abuse, walking shoes, probably a tablet or iPad now for digital resources. That's easily another $2,000 up front. So we're at about $12,000 minimum. Some families spend closer to $15,000 when you factor in extra clothing, winter coats for cold climates, or helping out with pre-MTC expenses. And here's the timeline pressure. Young men are typically called around 18, young women around 19. That means if your kid is 8 years old today, you've got 10 years to save. If they're 13, you've got 5 years. The clock is ticking, but you also can't afford to lose money to penalties. Okay, let's tackle the elephant in the room. Why can't you use a 529 for a mission? Here's what a 529 plan actually is. It's a tax-advantaged education savings account. The IRS lets your money grow tax-free, and you can withdraw it tax-free and penalty-free, but only if you use it for qualified education expenses. The IRS defines that as tuition, fees, books, supplies, room, and board for someone enrolled at least half time in a degree or certificate program. Notice what's not on that list? Mission service. The Church of Jesus Christ of Latter-day Saints is not an accredited educational institution for IRS purposes. Your missionary is not enrolled in college while serving. They're not taking classes for credit. They're serving, which is beautiful and valuable, but it's not education, according to Uncle Sam. So what happens if you withdraw that money anyway? You pay a 10% penalty on the earnings, plus you pay your full income tax rate on the earnings. Let's do the math on this. Say you saved $10,000 over 10 years and it grew to $14,000. That's $4,000 in gains. You pull it out for the mission. You owe 10% penalty, that's $400 right off the top. Then, if you're in the 22% tax bracket, you owe another $880 in taxes. That's $1,280 you just handed to the IRS that you could have avoided. Now, some people will say, but wait, I heard you can transfer it to a sibling or use it for college later. True, you can. But that doesn't help you pay for the mission that's happening right now. You still need $12,000 in cash. And if that money is locked in the 529, you're either taking the penalty hit or scrambling to find money elsewhere. This is why the 529 is a trap for mission savings specifically. So where should you actually put it? The simple answer, and for most families the right answer, is a high-yield savings account. As of December of 2024, high-yield savings accounts are paying around 4% to 4.5% APY. That's not going to make you rich, but it's safe, it's accessible, and it's not going to penalize you when you need the money. Let's run the same example. You save $10,000 over 10 years, earning 4% average. You'd end up with about $12,000. Not the $14,000 the 529 might have given you, but here's the thing. You get to keep all of it. No penalties, no taxes on the withdrawal because savings account interest is taxed yearly as you earn it, not when you withdraw. So let's compare. 529 plan, $14,000 minus $1,280 in penalties and taxes equals $12,720 net. High yield savings account, $12,000 minus 0 equals $12,000 net. So actually the high yield savings account gets you pretty close, and you have total flexibility. If the mission gets delayed, no problem. If there's an emergency, you can access it. If, and I know this is hard to think about, your child decides not to serve, you haven't locked that money into an education-only account. The cons? You're giving up some potential growth. If you had 10 years and the market did well, a 529 invested in index funds might have grown faster, but you're also avoiding the risk of market downturns right when you need the money. Imagine if your missionary gets called in 2026, but 2025 was a bad market year and your 529 dropped 20%. Now you're pulling money out at a loss. The high-yield savings account is the slow and steady sleep well at night option, and for most LDS families, that's the right call. But here's where it gets interesting. What if I told you there's a way to get the growth potential of a 529 and the flexibility of a savings account? This is what I call the 10-year mission savings ladder. Here's how it works. Years 1 through 5, the growth phase. If your child is 8 to 13 years old, you've got time. This is when you can take some calculated risk. Put 60 to 70% of your mission savings into a taxable brokerage account, something like a target date fund or a simple index fund. You're going to pay taxes on dividends and capital gains as you go, but you're getting market growth. The other 30 to 40%, that goes into your high-yield savings account as your safety net. Years 6 through 8, the transition phase. Your kid is 14 to 16 now. Start shifting. Every month, take the brokerage account balance and slowly transfer portions to your high-yield savings account. You're de-risking. If the market has done well, great. You lock in those gains. If it's been flat or down, at least you're not panicking because you still have 2 to 4 years of runway. Years 9 through 10, the safety phase. By the time your child is 17 to 18, 100% of the mission fund should be in high-yield savings or a money market account. Zero market risk. The money is there, stable, ready to deploy the moment the call comes. This ladder strategy lets you capture growth in the early years when you have time to recover from a downturn, but it protects you in the final years when you can't afford to lose anything. And here's the beautiful part. If you've been paying tithing on this money as you earn it, and I assume you have, you're already being a faithful steward. This strategy just optimizes how that money grows before you need it. Now, I know what some of you are thinking, and we need to address it, but what if my child doesn't serve a mission? Look, this is real life. Not every young man serves. Not every young woman serves. Health issues happen. Faith transitions happen. Life is complicated, and we don't live in a world where every 18-year-old walks into the MTC. This is actually where the hybrid strategy shines. If you put everything in a 529, you've locked that money into education. That's fine if they go to college, but what if they want to start a business? What if they need a car to get to work? What if they want to serve a mission later as a senior couple and need seed money? With the hybrid strategy, especially the taxable brokerage account portion, you maintain flexibility. Yes, you'll pay capital gains taxes if you cash it out for non-education purposes, but that's just normal investing. You're not facing penalties. You're not stuck. And here's the faith-based perspective. We save for missions because we have hope. We're planning for something we believe will happen, but we're also wise stewards. Proverbs 27:12 says, "A prudent person foresees danger and takes precautions." Having a flexible savings vehicle isn't a lack of faith, it's wisdom. If they do serve, perfect, the money is there. If they don't, you've still been a good steward, and that money can bless their life in whatever path they take. Okay, let's bring this home. The 529 plan sounds great for mission savings, but it's a trap. You'll pay penalties and taxes that wipe out your gains. For most families, a high-yield savings account is the safest, simplest move. 4% growth, 0 penalties, total access. But if you want to optimize, use the 10-year ladder. Aggressive growth in the early years in a taxable brokerage account, 10% gradual transition to safety as the mission call gets closer, and 100% in high-yield savings by age 17. If you found this helpful, do me a favor. Share it with another LDS parent who's trying to figure this out. We're all in this together, and the more we can help each other be wise stewards, the better. I'll see you in the next one.